Okay, welcome to another Finance Friday. This is Jerry here, owner, founder, CEO of Wealth DynamX, coming to you with our weekly Finance Friday course tonight to talk to you about annuities. Okay, and this is a topic that it's either going to be extremely applicable to you, or it's not going to be applicable to you at all because it's not something you own or that you sell or that you know of. Either way, it's important for you to understand. Okay, so I'm going to talk to you about what they are, how they work. Before we do that really quick, just a few housekeeping rules as usual. If this is your first time tuning in, welcome. We do these courses every week. We've done them every week for years now. If you've been tuning in for a while now, welcome back. We're great. It's great to see you again. We're glad to have you back on board. If you're watching this on social media, be sure that you share the stream and get the word out there so that other people can see this. This is something that is important for those of you that are, like nearing retirement. Maybe you own annuities. Maybe you sell them. Maybe you've never heard of them before and you're like, what is an annuity? And so each of those I'm going to talk to and address tonight. But the main thing is it's about financial literacy. Okay. Whether it's annuities, we've talked last week about indexed universal life insurance. We've talked about Bitcoin. We'll continue talking about different things. These are all products and services in the financial world, which means that I'm potentially going to be offered them. I'm potentially going to be at a decision point of, do I invest in this? Do I put money in this? I'm potentially going to be in a situation where a friend or a family member gets involved with them, right? And so if I have literacy, I become a stable point. I become somebody that can share the truth about them, that can spread literacy, that can help, rather than somebody that's on the sidelines wondering what's going on. So let me just give you full upfront. There are tons and tons of products, services, financial tools that I don't own, I don't get involved in, but I know them. Right. And that's because I take pride in understanding and being financially literate, because I understand that that's the building block of wealth. That's the building block of financial freedom. So it starts there. Right. So couple of things before we dive into this. We will be talking about, again, it's a product, which means it's an arbitrary. Somebody at some point made up what an annuity is, which means it's going to be filled with vocabulary and terms and concepts and math and things that aren't naturally going to be things that we might understand right off the bat. They're not things that we hear in day-to-day conversation. So I want you to readily ask questions. Drop them in the comments, in the chat, whatever it might be. If you're on Facebook, we'll read all of your questions, go through them one by one and give you answers. If you're on Zoom, we'll go live. We'll talk about your questions live. We'll answer them on air. You'll be able to talk with me. I love doing that, by the way, because I don't get to talk to people as much as I used to. This is a great opportunity for me to connect with people where I might not be able to otherwise. Okay. So that's the first thing. Second thing is have a reason for being here, right? Like a real reason, whether that be, because you have an annuity or you're learning about them or you sell them or you, just like I said, you'd like to know about them. But those of us that don't have a reason to be here, a purpose for learning this information, it's going to be a really hard course for you to pay attention to. Right. Not only that, like you're either not going to have a reason and you're going to quit, or you're going to have to come up with a reason, which is going to be usually something, on the consumption basis of entertainment or, being a troll in the comments or whatever it might be. Right. So have a reason for being here. Think about, how am I going to apply the information? And then again, be a producer, not a consumer. We're not here to get financially obese. We're not here to get intellectually obese, where we consume a bunch of information that we're never going to burn off and use. Right. So I want you thinking about, okay, I'm going to produce with this. I'm going to somehow use this. And that's the reason why I'm here. And that's the basis for all of the active listening I do. The questions that I ask is to actually use the information and put it to work. Right. Just like you eat food, the purpose of eating food is to first get calories so that you can burn them off at another point. Right. It's not just because you're hungry, like your body needs calories and you're going to do things throughout the day that burn those calories off. Okay, so that's the basis of what I want to start with tonight. Now, an annuity, the first thing I want to jump into is a little bit about my story with these. Okay, so I got into the retail mainstream financial industry at the age of 18. I'm almost 30 now, which is hard to believe, but it's the reality. Okay, so 18 years old was when I got life insurance licensed. Probably the very second thing I ever sold was an annuity. Right. I was selling first, it was, life insurance and the basics. And then I had a client and I learned about what an annuity was. And for me, it sounded like the greatest thing in the world. Right. Now realize this was 18-year-old Jerry. I had no financial literacy. The only ounce of like financial knowledge that I had was what I learned on the state life insurance exam, which is not applicable information. You learn that stuff. Nano can attest, you learn it, 90% of it you never use again. Right. And it's not something that on a daily basis is actually going to help you or fit you as an individual or as an investor or as a person with finances. Right. So that was like the basis of my financial education. And so I was hearing about these annuities and I was like, man, this sounds really good. Right. Like this sounds like something that I would want, anyone would want. It also it pays me a commission. So that's good too. So I'm going to try and market and sell this. And I want to start with that's where most people in the financial industry start. Okay. If I were to break the financial industry down, like I would say that if we did the reverse pyramid thing, I would say that right here is like 1% that actually knows what they're talking about. Of all financial advisors, licensed agents, whatever it might be, wealth managers, I believe that there's only 1% of them that actually know what they're talking about. Okay. I think that there's another chunk here that sometimes know, right? So we could call this maybe like 50-50, like they know certain things, but they don't know all of it. Okay. But at least they try, right? Like these guys are the 1%, which is the group I'm in. Like we eat, sleep, and breathe this. I was telling Nano, like for me, I just would learn about annuities because I wanted to know about annuities. I would read it once or twice and be like, okay, I got it. I understand that. I now know how annuities work. Let's move on to the next topic. Okay. And then there's other people where they're going to learn basically about, what they encounter in the world around them. If I'm a financial advisor, if I have to sell a certain product, like by all means, I'm going to go learn about that product. Right. But I might not learn about something that competes with my product, or I might not learn about something that I'm not licensed to sell, or I might not learn about something that is, out of my realm of things I could offer. Okay. So I think that that's a smaller chunk, but larger than this one. And then I think here is probably the majority. They basically are just Me Too people. When I say Me Too people, I mean, they just repeat what their manager told them. This is the majority of life insurance agents, financial advisors. They just get data from a manager and they just regurgitate it, right? Whether that be how a product works or why somebody should get involved in something or why this is a good thing and that's a bad thing. They don't actually think for themselves. They're basically stimulus response. They just hear it and they're like, oh, my manager, my upline, my general agent said this. This must be true because everything my manager says is true. Right? Sound familiar? Everything mom and dad say is true. Everything the pastor says is true because they don't think for themselves yet. Right? So you're not ever actually getting their opinion. You're just getting a regurgitation of what someone else said to them at one point. Okay. And then there's another chunk that basically they don't know anything, right? These people make stuff up. Right? They're in the financial world because they know that they can make good income doing it. And so they'll tell you whatever they need to tell you. This is like the used car sales guy. Right? Who's ever had that where you bought a car and you just could tell the guy was making stuff up? He's never driven the vehicle. He's not an expert on it, but he just knows how to talk really well. Right? And so there's, probably not as big as this majority, but there's a big chunk here that just makes stuff up. They're used car salespeople. This is probably the second largest group in the industry. This is probably the first largest group in the industry. Right? And then we've got number 3, and this is the last. Like not very many people actually get to the point where I am at. Okay. And that's not putting the spotlight on me. It's guys, this has been 10 years of me studying and working and learning, right? Now, all of that to say, this is why you got to know this stuff. Because the guy you're talking to, let me tell you what, if he's in the top 1%, there's 2 types of people in the top 1% of the financial industry. There's the people like me where we know and also have good intentions, meaning I share my knowledge to help. And it's not something where I'm going to be like, okay, I know all these things and I know that this person doesn't. And it's like a shark underwater and I'm going to come get you when you're not looking. Right. But there's a percentage of people in that group that are like that, where they know all of the things that I know and they have poor intentions. Their goal is no different than the used car guy. They just figured out it's better camouflage to be able to say, these things, because then people buy into it and they believe you. Right. So if you're the consumer, there's a very high percentage of chance that you're just talking to somebody that's blowing smoke out their butt. They're just telling you what their manager told them. Right. And if you don't know that, and you don't know the truth about the products and services that are being talked about, then you're in a position where you're going to be the victim. You're buying something you don't understand, relying on the person because they go to your church or your school or your kids know them or they were a referral and they don't know it either. And so that means in the equation, you plus you and them plus them, you add all that together, there's no knowledge there. Right? The scarier part is the manager that they learned it from is in one of these 4 groups as well. Okay. Chances are their manager was a Me Too guy as well. So they learned it from the manager and they're just believing what the manager said. Well, guess what? He learned it from his manager. He's just saying what his manager said. He doesn't think for himself either. His manager doesn't think for himself. And it goes all the way up the line until you get to whoever originally told them what it was. And it's probably one of these guys. And the financial industry does not have a good track record, right? So the majority of these guys in the top 1%, they don't have good intentions. If they did, I wouldn't be seeing, you know, every so many years some documentary that comes out about how the banking industry or the insurance industry or Wall Street took advantage of the mass population in the United States. That wouldn't be a trend, right? We wouldn't see stats like, you know, 80% of America's paycheck to paycheck, 60% of less than $1,000 in savings, 80% of retirees are going to run out of money in 10 years. The stats would look different if people were doing a good job, right? So that's the mindset I want you to have as we're going into this is you're at some point going to be faced against one of these four groups because you are a consumer and I want to turn you into a producer. I want you to know more than these guys do. I want you to know as much as Jerry Fetta does, as much as Nano Aquino does, so that you can sit across from someone who might be pitching you this and you know more than they do, right? If you've heard my story, and I'm going to start out with this, one of my very first learning experiences with annuities is sitting down, and I was doing something called field training, which is where I sit down with the guy that recruited me. And you know, we go to one of my friends, one of my family members, and we basically pitch them the deal, right? And I do the presentation and you know, hopefully they buy, and my manager's there to help with whatever I need if I mess up or I need him to interject. And so I went and I saw my best friend's dad at the time. And this kid I went to middle school with, high school with, like I knew his family very well. And I remember talking to him and I was like, you know, this guy's very financially literate. I know that they're well off. They've got money to invest. Like for sure, I'm going to make this sale, right? For sure. They like me. They trust me. They're qualified. Why wouldn't they buy? So I sit down and I'm doing the presentation, right? I'm pointing in all the stuff and I'm talking to you about the annuity, telling them all the features and why it's a good idea. And I was doing, at this point, I was the Me Too guy, right? Like I had too much integrity and ethics to be a used car salesman. Otherwise I would have just, you know, been peddling terribly designed whole life insurance policies and universal life insurance policies, right? So I wasn't just a used car guy. I was the Me Too guy. I thought I was doing a good thing. I thought I was sharing helpful information, right? But really I was sharing what my manager taught me. I didn't figure out where he got it from, but the guy that I was pitching this to, he was in the 1%. He knew the product that I was selling him better than I did. So when I explained it to him, I didn't have a real understanding. I was just saying the next line. It's like being an actor, right? You memorize your script and then you can tell the script to the client and you sound really good and you know when to do your dramatic pauses and you know when to ask for tie downs and you know when to trial close and all these things. I had that down beautifully, right? But I'm sitting there and I get done and the guy that I'm pitching, I'm talking to, he stops me. He's like, okay, good. I understand that. And then he's like, let me explain back to you what I understand about what you told me. He said everything he understood, but he said it, A, first of all, correctly, but B, he explained it back to me in a better way than I did and more simplified than I did. And C, when he did that, it no longer sounded like a good idea to me, right? Like I got flipped right there at the kitchen table with him. And it was an annuity, right? So what is an annuity? That's the first thing I want to cover. What is the annuity? So if we do a definition, let me pull up like Investopedia really quick, because I want to give you the technical definition before I give you the Jerry Fetta definition. What is an annuity? An annuity is a financial product. That's the key term. It's a financial product that offer guaranteed income streams, usually for retirees. So it's a financial product. It typically offers a guaranteed income stream for a retiree, very similar to a pension, right? There's an accumulation phase, which is the first stage of annuity whereby investors, and that would be the wrong term, but the person that puts the money into it funds the product either with a lump sum or periodic funds. So they're saying there's two sides. Side number one is accumulation. If you're a client and you pay attention to my stuff, I want you to think about what is already wrong with what I've shown you so far. Okay. And then the other side here, side number two, is distribution, right? Or technically this is called annuitization. So they're saying you can put lump sums, you can fund into the annuity, you can do payments and fund it with contributions. At a certain point, you're going to need income, right? So you need income. And so you would then do the annuitization or the distribution, and this is then going to pay out payments. Okay, payments usually are periodic or guaranteed for a certain period, right? So it says the annuitant begins receiving payments after the annuitization period for a fixed period or for the rest of their life. So the payments are periodic, right? So they're either fixed, meaning they're going to pay me out for 10 years or 15 years or 20 years, right? Or they're paid out for life. They're going to pay me out till I die, right? And then at that point, that the payments are done. Annuities can be structured into different kinds of investments and instruments, which gives the investor flexibility. These products can be categorized into immediate and deferred annuities, and they may still be structured as fixed or variable. Okay, so basically with an annuity, what you're doing is you're taking either a lump sum or you're taking income, right? And you are putting this into it. It's an insurance product. Okay, it's not an investment. And that's why I corrected Investopedia. It's not an investment in most cases. Usually it's an insurance product. There is a way for it to be an investment. That's called a variable annuity, where it goes in mutual funds. Most of the time, it's not that. Most of the time, it's an insurance product, right? So you have the accumulation, right? This is either a lump sum or a payment, meaning I'm going to take, a chunk of money. Let's say that I've been working at the same company for 20 years and I built up my 401k account and I've got $200,000 in there, and I leave that job, right? And I go see my financial advisor and I say, hey, what do I have? I've got 200 grand. What do I do with this money, right? And they say, oh, put that into an annuity, right? You're going to put a lump sum at that point. You're going to do a rollover or a transfer into your own individual retirement account and put that into the annuity, right? Or I can do payments. I can say, hey, I want to put in $1,000 a month or $500 a month for whatever period of time into this annuity product. Accumulating, right? Now, when I do this, there's 3 different ways that this can get invested. There's what's called a fixed account. There's what's called an indexed account. And there's also what's called variable. Okay. Fixed is like a CD, a certificate of, I call it a certificate of depreciation, but it actually means certificate of deposit, right? They're going to pay me a fixed rate. Maybe that's 3%. Guaranteed 3%, can't lose money, always going to make 3%, but I'm never going to make more than 3%, right? That would be like a fixed annuity. And it's going to continue doing that until I annuitize, right? So the way that an annuity works is during the accumulation, this is where I'm credited growth. If I'm in a fixed account, whatever my fixed rate would be, as soon as I distribute or I annuitize, I no longer get credited growth. Right? Whatever amount it grew to. Let's say I put in 200,000 and I turned it into 300,000 by the time I wanted to draw income from it. They're going to freeze the account value at 300,000, right? And then that's the number that they're going to use to determine what are my distributions, right? So if I do a fixed period, I say, I want you to pay this out over 10 years, right? They would take the 300,000. They might use some sort of a mathematical factor of interest and say, okay, well, we're going to pay you, this number over a 10-year period. Once it's gone, right? Then there's the lifetime payment. They're going to say, well, your estimated lifespan is, 84, and we're going to pay you out till you're 84. Now, here's how it's pitched. Guaranteed to grow, guaranteed against loss. Sounds great, right? Payments for life. If you do this, if you run out of money, we still keep paying you. Think about it. If I drain my $300,000, the insurance company is saying, we're going to keep paying you even though you ran out of money. So if I'm a pre-retiree and I'm worried that I didn't save enough money, this is where a lot of these are pitched is you're 50 years old. You didn't quite save everything you wanted to. You're at risk of running out of retirement income. Let's put you into an annuity. Let's do guaranteed income for life. So that way, you're never going to run out. Okay. Again, on the surface, that sounds really good. Could you see how 18-year-old Jerry, I'm in the Me Too category of this is what my manager said, right? And that sounds really good. I'm like, oh, that my mom could use that. Whoever could use that because I don't want them to run out of money, right? Now, that's the life payout. The 10-year would be the fixed. Now, the other thing is you have indexed. We talked a little bit about what indexed means last week on indexed universal life insurance. This is very similar. The insurance company, this is going to sound very complex because it is. They take the money you gave them, they buy bonds with it. Bonds pay out an interest rate, whether that be, a lower interest rate because it's like a treasury or something of that nature, or a higher rate because it's a corporate bond. Usually it's on the more conservative side. They buy bonds with it. With the interest that they produce with those bonds, they usually keep about 90 to 95% of that in their pocket in the general account. And then usually about 5 to 10% of that interest that they're earning, they day trade with it. They buy options. Options are the ability to buy the contract right to buy or sell stock at a given price in the future, right? So they'll do options trading with it. And so what they do is they'll take this little chunk of money, they'll put, towards options. If the market goes up, they get a bunch of money in, and so they can credit you a percentage of the growth. And so long story short, they'll tell you, hey, we'll give you a participation rate in a market index, whether that be the stock market or real estate or gold or what have you. We'll give you, let's say it's the stock market. We'll give you 50% of whatever the S&P 500 does. Okay. They'll give you a cap. They'll say you'll get 50% up to this number, right? And then they typically will have a way that that's measured, whether that be, an annual mark where they say, hey, this date to this date every calendar year is where we credit your growth. They're going to pick that too. And then they usually also have a floor. So you might get 50% of the upside with 0% of the downside. Okay. Again, that sounds really attractive. Like, I would like that. Good. So that's an indexed account. Variable. You have a variable annuity. This basically goes in mutual funds. Okay. I like to call these MFers, mutual funders, right? This usually goes in mutual funds. So these are the three ways that an annuity can grow. Now realize, I'm going to back this up again. We've got either a lump sum or we've got periodic payments of income or contributions. We're putting this into the annuity account, right? Again, the money that we're then putting into the annuity account is either being credited growth on a fixed basis, right? Where it's going to give me a fixed rate and I'll never make more than that. I'll never make less than that. Or it's going to give me growth on an indexed basis. I'm going to get a percentage of participation with a certain market index, stock market, real estate, gold, right? There's all sorts of them that they can use. Or it's variable. They're going to literally put me in a mutual fund and I get whatever I get. And there's usually not a guarantee against loss, right? Like there can't be. Variable annuities are one of the most complex things out there. Usually though, it's I can get a percentage of the upside. And then on the downside, right, my account value can go down, but if I put certain riders on, I can defend against that. Okay. So these are the ways it would go. Now, when I annuitize, again, I get to a point where I'm 60, 65 years old, whatever it might be, and I want to start drawing income. I then annuitize. When I annuitize, I do not get growth anymore, right? They lock, like I said, they lock in my account value. If I'm doing a period of fixed payouts, they're going to give me 5 or 10 or 15 years, whatever I decided upon. Okay. And then if I do, the lifetime payout, they're going to pay me out a smaller amount over the rest of my life. I'm never going to run out of money. They pay me forever. That sounds great, right? It sounds awesome. So I sold one of these. My first sale ever on an annuity was actually to my mom. I sold her an annuity. It was like $50,000. Okay. She put money into it. She passed away at 60. And so it never ended up doing the retirement income. Instead, it just paid out the account value when she died. But I had another client where he did have like $300,000. Still a client today. We got him out of the annuity. I'll talk about that in a little bit, but he had about $300,000. And so I was telling him, I was like, hey, this is this product. You put money into it. It's guaranteed against loss. You get a percentage of what the market does, and then when you're ready for retirement, you get income for life. Even if you run out of money, the insurance company keeps paying you. Okay. That's basically the sum. And if you sat in front of an insurance agent or financial advisor, that's usually the pitch. Like within so many words, that's usually what you're going to hear in a nutshell. Okay. Now, here's the thing, right? The way that an annuity works is, again, if I'm fixed, I'm not making more than 3% ever, right? I can think of a lot of places where I can earn more than 3%, right? So I have to look at this is a retail financial product. It's not an investment. It's a product. Someone in a boardroom put this together for the benefit of the company and the shareholders first. Otherwise, they wouldn't sell it. Now, the byproduct, the nature of it is maybe by circumstance, it also might benefit the client as well, but it is a product, right? So product means that the boardroom makes the rules, the insurance company makes the rules, and they're always going to be the one that wins first, right? And so we have to think about that. Now, are annuities bad? No, they're an inanimate object. They're amoral. It's no different than saying spoons cause obesity or guns are responsible for murder. They're not. People that eat with spoons too much, that causes obesity. Criminals that fire guns at people, that causes murder. Annuities that are sold by, again, people that are sleazy, people that are just repeating what their manager told them, people that have only half the information, and people that know everything, but they have bad intentions, that makes them a bad fit. But it's actually the individual selling them, right? So again, they're not bad, but that also means they're not good. They're neutral. right? You can make an annuity helpful for someone. You can also make an annuity harmful for someone, depending on, again, what's the ideal scene? What's the purpose? What are the statistics and indicators that I should be looking at with this product to know whether it's a good thing for this situation or not, right? So here's what I got to say up front. 99% of the time, and I know that's a bold statement, 99% of the time, if you're an individual and you're accumulating, you shouldn't be using an annuity, right? And here's why. Here's why. So let's say that I have $100,000, right? $100,000 in cash. And I'm like, man, I want this to go towards my financial freedom, right? So if I take this $100,000 in cash and I put this into an annuity, again, this is not inside of a retirement fund currently, it's just cash, right? If I put this into an annuity grows on a tax deferred basis, meaning it is similar to an IRA or a 401k. When I put money into it, the growth of the account's not taxed during the time that the funds are in the annuity. Once I start making withdrawals, then I pay my taxes. Doesn't sound like a big deal, right? But the fact of the matter is, with an annuity, because it's tax deferred, I'm legally not allowed to access those funds until I'm 59 and a half years old. Okay. Which means for me, if I'm 30 and someone sells me an annuity, that money is locked up till I'm 60. Unless I want to pay early withdrawal fees and taxes, right? So this, again, I said at the very beginning, find what's wrong with this. The idea of accumulation, that's what's wrong with this. That I'm going to buy something and hope it goes up in price or value and it turns into a nest egg so that one day I can draw off the nest egg and hopefully I die before I run out of money. That's not a good model. That's an industrial age concept. It was created by banks, Wall Street, and the IRS to get you to work for the rest of your life for them, 40-year to life sentence, working 40 hours a week or more, with the dream of retirement, right? Like this happened, like you used to get pensions. This happened recently within the last 50 years. Pensions went away. We went to 401ks and annuities and deferred compensation plans, right? You're deferring your life. When you do that retirement model, you're deferring your life. My story is, guys, my mom died at 60. The year she was allowed to take retirement distributions, she passed away from cancer. Okay, I'm not the only one that happened. I had a guy tell me today, he talked to a client, a guy's 64 years old. He lost, he didn't have an annuity, he was in the market, but he lost $100,000 in his retirement account last year. In the same year, gets diagnosed with a terminal disease and given less than 12 months to live. Okay, very delicate situation, very touchy situation. But let me ask you, if you're in that guy's shoes, are you happy that you put your life off till you're 60? I'm not, right? I would have preferred to live and travel and have fun and do all this stuff that matters, because that's what living is. It's not about wait till you're 60 so you can retire. Guys, when I'm 60, like I can't do half the things I can do today, right? Like my body is just not where it needs to be. I can't go like, you know, today I went for a run just because I felt like going for a run, right? I like doing intervals. I like doing sprints. I enjoy that. That's something I'm probably not going to be able to do like I can today when I'm 60. So if I'm slaving away at a job, and there's nothing wrong with jobs, but if I'm slaving away at a job just to earn a paycheck, just to fund retirement, just so that when I turn 60, I can finally stop doing the job that I hate, that's not wealth. That's not financial freedom. And that's not a good lifestyle. So an annuity puts you in this, it commits you to it. You are doing the retirement game. You are doing the turn 60 and then hope I die before I run out of money game. Okay. So you're in a tax deferred account with the cash. You put it in, you cannot get it out now till you're 60. Okay. The other factor is they have surrender charges. Surrender charges are back-end fees that penalize you for accessing the money in addition to the taxes, usually for the first 7 to 10 years. So let's say that I put this in cash, I put it in the annuity, right? And I decide in the second year, I'm like, okay, I don't like this. I want out, right? Not only am I going to pay income tax, state and federal, right? Not only am I going to pay a 10% early withdrawal penalty, I'm also going to pay a surrender charge. Right? So let's say my federal income tax rate is 15%. Let's say that my state is 5%. I'm paying 20% here, right? Paying a 10% penalty. Surrender charges usually start around 7 to 10% and they drop over time. But let's say I'm in the second year and the surrender charge is 9%. Okay. For me to pull my money out of this annuity, guys, I'm paying 39%. Okay. That's terrible. In my opinion, that's criminal. Like that's not okay. Right? Like there's no reason why those fees and penalties should be there. Most people, when they get into them, they don't know this. The agent doesn't really know. They say, hey, there's a surrender charge, but what they say is they brush it off, but you won't need to use that. You won't need to access the money anyways. Well, what if you do, right? They say, oh, there's a 10% penalty and there's income tax, but they kind of assume like, you know that. That's how retirement accounts work. That's how deferred compensation works. That's how tax deferral works. Until you're there and you're like, I need this money, like you're not going to think about these things, right? So this is on the cash basis. Now, if you're putting it in a retirement account, here's the one single time where I think it's a good idea for somebody to use an annuity, okay? Actually, let's say there's 2 times, one of the 2. First is if you have less than, that's the wrong side for less than. Let me correct that. Okay, so if you have less than, usually about $15,000, and it's in a retirement account, and you have no investing experience, this would be one of the 2 times I would say an annuity is a good idea, right? Why would this be? Number one, you've got less than $15,000, right? If you have a retirement account, we're usually going to tell you self-direct it. Put it in an account where the custodian allows you to do real estate and gold and silver and alternative assets rather than just put it with Wall Street. Trust them. Every horror movie ever made about finances involved Wall Street. We should definitely trust them with your money, right? So a self-directed account would allow you to do other things, but if you got less than 15,000, you don't really have the firepower to do that. So I wouldn't say put it in a self-directed IRA or anything like that. So that's off the table, right? So that's why it's less than 15,000. It's in a retirement account, right? And why would we specify this? Because if it's in a retirement account, you've already got to play by these rules. You already can't touch it till you're 59 and a half. There's already penalties and taxes if you do. So if we put it in an annuity, you're not adding anything new. It's all the same rules you already have to follow. Right? Versus if we do this with cash, we're putting handcuffs on you that weren't there before. And now your money is locked up. You see the difference? So if it's already locked up, it's like, okay, great. They're going to enforce the rules that are already existent on these funds. And then if you have no investing experience, right? You've never done gold and silver. You've never done private lending. You've never done a real estate deal. And when I say investing experience, I mean, you actually are in the driver's seat. Not you hired some guy to do some trading or you hired a broker. That's not investing. That's consumerism. That's a consumer financial product. You're not an investor. You're the consumer, right? It's like saying I went to a restaurant and then claiming I'm a chef. You're not. You went to a restaurant. You ordered off the menu. They brought it to your table. They cooked it. You just ate it, right? When you buy a mutual fund, you're not the one doing the investing. They are. You ordered a product off of their menu. They brought it to your table ready to eat. If it's good, if it's bad, that's not up to you. You've got no say in the matter. You're the consumer, right? Produce, not consume. Okay. Outflow better than inflow. So no investing experience. This would be someone that I would say do an annuity, right? The reason being, you can't do much with this money. You're already in the handcuffs with the IRS and you've got no investing experience. We wouldn't put this in gold and silver. We wouldn't put this in mutual funds. We wouldn't put this in real estate. Okay. Because you don't have knowledge, responsibility, and control on those topics. You've never done them before. Right. So in an annuity, like at least we know we would never do fixed. We would probably do index. We'd say, at least we know you're going to get 50% of the market. You're probably going to average, 3 to 5%, maybe 6% on a good year, but you're never going to lose money. And in 10 years, when this is now 25,000, 30,000, whatever it grows to, right now you're big enough that we can pull it out of the annuity and put it into something else. So it's a temporary holding place. That's where we would use an annuity. The other time we would use an annuity would be with somebody that is elderly. It's all the same circumstances. They already have a retirement account. So these are retirement funds. The account value doesn't matter so much. So whatever the number would be fine. And then they have limited investing experience, right? Limited investing experience. Okay. Why would we do this? Because A, we're not about to throw grandma in a day trading account, right? Like it sounds cool, but it's probably not a good idea. She's 70. And if she loses all her money, that's not good, right? So she's elderly. It's probably okay. She's not looking for super aggressive investing. She's looking to keep track with inflation, stay out of the market. Because if you go into Wall Street, here's what's going to happen: fees and volatility. Those are the only two guarantees with Wall Street. You put it in mutual funds, stocks, bonds, it does not matter. Fees and volatility are the only two guarantees that you get in that kind of a deal. So if I'm 70 years old and I've got $500,000, right? I don't need fees and volatility in my life. I need to make sure that I don't lose my principal. An annuity doesn't lose principal. So that's fitting. B, I get some growth. An annuity does get some growth, right? I can get, indexed performance. So I might get 3, 4, 5%, right? Not great, but it's better than you could get 12, but you could also lose 30, right? Or, the limited investment experience. Grandma's not going to go learn about real estate. She's not going to learn about private lending. Even if we put her in it and something happens, she's not going to let's go to court and let's foreclose on the property. That's probably not a good idea for somebody that's that age, right? Mark my words. These are the only 2 times an annuity would be okay, in my opinion, right? Now, why would I not do this with someone else? Someone that's 30, 40 years old, they're saving, they're doing retirement. Let me break this down from the investor hat. We're going to change our viewpoints here, right? Consumer hat, you put in a lump sum or payments over time. And let's say we do the fixed account, right? If I'm the insurance company, how can I guarantee you 3%? How can I guarantee something? Wall Street is not allowed to guarantee anything. Why would I be able to, right? Well, I would have to have the financial strength and the solvency to be able to do that. There's a certain number where the government says, okay, you're not going out of business. We know that you're going to be able to pay out, so you can guarantee stuff, right? So that speaks to, I've been around for a while. I've got my assets and reserves in place. And also, I'm very profitable. My sales are the reason why my assets and reserves would be at that level, meaning I make a lot of money from my clients. You're my client, right? If I sell you an annuity, it means I make enough money off of you and your friends and all the people like you to be in that kind of financial position where I can use the word guarantee. In a world where anyone else would go to prison for it, I'm allowed to use it, which means I make that much money hand over fist that I can say I can guarantee returns. The other one is I make more than 3%, right? For me to pay you 3%, it's not that hard to think about. I make more than that, right? How much do I make on that? Okay, well, insurance companies, they're giant, right? Like, especially, these old mutual companies and some of these annuity companies, they're huge. They're multi-billion-dollar companies, right? Like, when I talked to one of the wholesalers back in the day when I used to sell these, what he was telling me, he's like, yeah, so, he was talking about the back end. He's like, yeah, so the insurance company, they take the client's money, they buy bonds, they take the interest from the bonds, and they do day trading. He's like, yeah, sometimes we make 30 and 40% returns. Okay. They are borrowing your money at 3% so that they can make 30. Okay. It's not pitched like that. It's not advertised like that because you wouldn't buy it if it was. Okay. For them to say, we can guarantee you against loss and guarantee you 3%, you're extending to them a 3% loan. Okay. They're committed to pay you 3% a year, right? So they can do whatever they want to with your money within their investment portfolio, making whatever they want to make, only having to pay you 3%. Think about that. Like that's ridiculous. So when I was selling annuities and I learned about private lending as an alternative, and I realized, okay, well, market rate for a loan, like on an asset-backed loan, where it's like real estate, 8 to 12% all day. In the private sector, I can charge 8 to 12% on my real estate lending deals. So that's a loan, right? An annuity would also be a loan. I'm extending my capital. They're paying me a rate to use my money, and I'm guaranteed that rate. If I can make, let's say, 9% on a real estate loan, why in the world would I do 3%? With an annuity company that's technically unsecured, meaning there's not secured by the title on a real estate project. I can't foreclose on the insurance company, right? So that's the first thing. Now, the other thing to think about is, okay, so you've been losing out. That's called opportunity cost. You've been losing out on, and this is on fixed and indexed. You've been losing out on whatever it is they could be making with your money. They're giving you whatever they promised. Great, right? So over a certain period of time, you can start to add up, well, what could I be making if I was them? Right? That tells you the upper end of what your potential profitability would be. Now, the reality is you're not them, right? But you could say, okay, well, somewhere between them and 3% or 4% is what I could be making, right? I know for a fact, you give me 50 grand or 100 grand, I can call my funds tomorrow and put it in a real estate deal that pays me 12%. Okay, so I already know that I can make 400% more money by doing that. If I do that till I'm 60, 12% over the next 30 years turns into a certain number. 3% over the next 30 years turns into a certain number. The difference between those two numbers is what the annuity costs me. That's opportunity cost, right? So that's the first reason why I would say most people shouldn't be doing this, okay? This, excuse me, the second reason is on the distribution phase. I personally think this is worse. Okay, it's worse than the accumulation. If what you said thought I said was bad, this is worse. Okay, so let's say that we're going to do the lifetime payments. We're going to pay you out for life. Even if you run out of money, we're going to keep paying you. Guys, you're going to think about these things. That's a red flag. If if I'm like, hey, even though your money ran out, I'm going to keep paying you. The first question I ask is, how can you afford to do that? Right? So think about this. They're going to pay you out usually about 7% of your account value. That's going to be the number. So if you have, just for easy math's sake, you have $100,000, they're going to pay you 7% per year for the rest of your life. That's $7,000. That's no money. You can't live on $7,000. Like, you basically can almost kind of sort of buy some groceries. That's it. Right? Even if it's $1 million, you do 7% of $1 million, right? Now you're at 70. Right? So you went from $7,000 to $70,000. $70,000 is still a tough lifestyle. And if you were again with $1 million, I could put you in a deal that's paying you 120. Right? So which would you rather have? Okay. Now, the reason why they can pay you 7% is because when you annuitize, your account stops growing. The number you're at when you sign the form to say, pay me distributions, it locks your account value. If you were at $100,000, you will never make more than that. You will always have the 100,000. That's the number they're basing it off of. So your 100,000 now becomes fully theirs. They just have to pay you 7%. Okay. How much more than 7% do you think they're making? Okay. Now here's the kicker is there are different beneficiary elections on annuities. If you select the wrong one, and again, your agent hopefully knows this, but if he doesn't, and he's just a Me Too guy or a used car sales guy, or he knows half the information, if you select the wrong one, when you die, if you had money left, the insurance company keeps it. Think about that. Okay. Now, again, they're not bad. If somebody does this, usually an agent is not going to do this. They're going to know well enough to know not to check that box in the form. Some of them don't, though, and I've seen it. Right? Where the box is checked and it's like, did you know when you die, your spouse doesn't get the money? The insurance company keeps it all. Right? So that's the first problem that I have, is that's confusing, and you have to really make sure. And it's not saying all of them are like that. A good percentage of them aren't. But you, as the consumer, probably didn't know that that was a thing. Your agent, if you own an annuity, probably did not sit down and tell you, hey, there's an option for this, this, and this on the beneficiary payout. We selected this one so that you get to keep the money and it goes to your spouse, right? You probably didn't know that's a thing. Hopefully they checked the right one. Hopefully, right? Hopefully people don't get in car wrecks. Hopefully people don't run red lights. Hopefully people exercise and they take care of themselves. I've learned we really can't rely on hopefully when it comes to human beings. We have to verify and see for ourselves. And if you don't know that that exists, you can't verify and see for yourself. Okay. So that's the first problem that I have. The second problem that I have is, again, the payout. How much money are they making beyond 7% to be able to guarantee me this? Right. And so that's what you've got to look at, is the insurance company. Once again, they made the product for them. It's theirs. Okay. Now, these income for life annuities, these are not free. These usually have a fee. Okay. That fee is usually 1 to 1.5% of your account value on an annual basis. So if I'm making 3%, my fee is 1% or 1.5%, I'm really only netting 1.5%, maybe 1% in that range. Right. So that's going to reduce my account value, which means my payments are going to be even smaller. Okay. If I'm in an index where it's like, hey, you get 50% of the market upside and 0% of the downside. Okay. Well, 0 minus 1.5 is not 0. 0 minus 1.5 means I lost 1.5% of my account value. Right. You've got to think about these things. Now, here's the third one that I didn't realize till many years later. This is not inflation adjusted. Okay. Meaning if this is 2021 and I'm retiring with an annuity and I'm annuitizing, right? And I'm going to take distributions and they're going to pay me 7% of my account value. Let's say it's $100,000 and they're going to pay me $7,000 a year. Okay. Well, inflation happens this year. CPI says inflation is 8%, which really means it's 16, right? My $7,000 doesn't buy jack shit anymore. Think about when I'm 80 years old, 20 years down the line, do you really think $7,000 is going to help me that much? Right? So they're paying me out a fixed non-inflation adjusted percentage. That is not good. That's not helpful for me. Right? So here's my thing. Even if, let's say it is this person where they're elderly and they don't have investment experience, if I was going to do an annuity, I would never, ever put them in the guaranteed for life account, right? What I would say is okay, we're never going to annuitize. You're allowed to take a distribution every year just from your account value. Let's just do that. Let's just take out less than the rate of return was. So if you made 3% or if you made 4% last year, we're going to take out 4% or less, so that we're never touching your principal. Your account value is still there. When you die, it goes to your spouse, your kids, or whoever it would be, right? I did a lot of annuities back in the day. Okay. Now here's my opinion. This, in my opinion, if again, we're not talking about alternative investing or any of the stuff Wealth Dynamics teaches. We're just talking about if I'm a financially illiterate financial consumer and I'm buying mainstream financial products. I do think this is better than the stock market. I think putting it into an equity indexed annuity where I'm going to get a percentage of the upside, none of the downside, is better than putting it in the hands of Wall Street. 100%. I would go that route. Now, fortunately, there's a whole nother world that exists in finances that, again, like this entire part of the triangle doesn't know about. They don't know about it because their manager never told them about it, because they don't get paid commissions to sell it, because they don't know about that half of the information, right? So there are things like, there are things like private placement investments. There are things like, life insurance policies that we can structure where you become your own bank. There's gold and silver investing. There's so many opportunities that are not going to be presented to you by a financial advisor. Why? Because a financial advisor is a sales and distribution force for banks, Wall Street, and insurance companies. The advisor is just a little button they give them so they feel cool about what they do, and there's some regulation, right? But at the end of the day, they're a distribution force, no different than someone selling solar, no different than someone selling used cars, no different than someone selling pharmaceuticals. They sell a product. They represent corporate companies. Those corporate companies create the product, underwrite the product, and then they use that as their distribution force to get the product into the hands of the consumer. Because in the financial world, the farther away you are from the client, the more money you make. So the guys that are meeting with you at the kitchen table, sure, you might make a good check, but they're not making the most of the money on the annuities. The ones that are is the insurance company that only has to pay 3% out to grandma. Well, they do options trading with the account and make 40% returns. And they do that with hundreds of billions of dollars. Think about this. Now, the other factor on this too is commission. Commission and licensing. Okay. Now, I'm not going to give you a blanket statement and say these are the reasons why everyone sells annuities. They're not, but they're big ones, right? So commission, annuities pay very high front-end commissions. Usually it's going to be between 5 and 10% of what's being put into the account. If I'm a financial advisor and I'm selling a mutual fund and the account is less than $50,000, the most I will make is 5.75%. As the account grows into a larger amount, that fee goes down. If it's, I think at 100,000, it goes down to like 3.5%. At $500,000, it goes down to like 2%. At $1 million, it goes down to 1%, right? So if I am in a position where I've got a client that has $500,000 and we could put them into the mutual funds and I make a 2% commission to do that, or we can put them into the annuities and I make, let's call it 7%, as we've split it down the middle, I make 7%. Kind of sort of 7% pays me more, right? And if the client doesn't know the difference and it's guaranteed against loss, and there's all these justifications and reasons why the annuity is an okay thing to do, a lot of advisors sell them simply because of the commission. Okay, I grew up in the industry in an environment where that was 100% the case, right? Like people getting presented with $30,000 and $40,000 commission checks, which is awesome. I'm all about that. But if there was a better option for the client and I purposely withhold that from the client so that I can show them something that I know pays me more money, that's unethical. That's wrong. Okay. And the majority of annuity sales happen because of that. Okay. The other one is licensing. With fixed annuities and indexed annuities, the only license that I have to have is life insurance. Why? Because it's an insurance product, right? So I can do retirement planning without having to have a Series 6 or a Series 63 or a Series 7 or a Series 65. All of these are very difficult tests. They're time consuming, right? They add, regulation and audits and all these complexities to the business. And so a lot of people don't get them. They'll just be like, hey, I'm fine being life licensed and I'll just sell annuities. Okay. Honestly, from like a business standpoint, I think that's easier. If I'm wearing the hat of a business owner, I'm looking at, okay, I could get securities license, I could offer mutual funds, and my world becomes an expensive nightmare, right? That's not a great, like, business only great decision, right? So if I'm looking at, okay, what's the easiest business model? The easiest business model is just get a life insurance license and just sell annuities. They're easier. There's less regulation. There's less work. There's less auditing, all this other stuff that goes into it. And they pay me way more in commission. Okay. Again, the consumer does not usually know this. Okay. They don't know what the commission is all the time. I think now they might have to disclose it. But again, like that's out of context. You could say I make 7% commission. Well, if I'm the consumer, I might assume that's what you make on everything. Right. It's a different story when you say I make 7% commission, but on those ones, I only make 2%. That's not on the best interest contract forms where I have to tell you what my commission disclosures are. You just know 7%. And I assume, oh, that must be normal, right? Now, here's the thing, like the commission right off the top, that's a loss. So that tells me, again, the annuity company is making enough money on this account that they can advance 7% commission on money they haven't even gotten and invested yet, right? Plus, they're going to guarantee it against loss. Plus, they're going to guarantee me 3 to 5%. Plus, they're going to guarantee me income for life, even if I run out. Right? To me, that just screams red flags. As an investor, I look at all of that and I question why. Where's the 7% coming from? Okay. How are you guaranteeing against loss? How are you giving me 3% every year, no matter what? How are you giving me money even though I ran out? And when I start pulling the string on those questions, those are the answers we come across on this course tonight. Okay. So in summary, that's what an annuity is. It's an insurance product. The one that I did not dive into, and I'll hit really quickly, is the variable annuity. This is down here. This is, again, instead of doing fixed or doing index, they dump it in mutual funds. Okay. Very expensive mutual funds. Again, on variable annuities and also on variable life insurance, it's not uncommon to see 3 or 4% annual fees, right? The market only has so much upside, right? If you look at the S&P 500, you annualize it, you might make 8% in an index fund per year, right? That's without fees being included. If I then include a 3-4% annual fee, I'm not making 8% anymore. I'm making about the same as I would make in an indexed annuity, but I have risk, right? So at least on an indexed annuity, I don't have risk. Now, again, the variable annuity, people would sell that because, again, they have to be securities licensed. The commissions might be generous. There could be bonus programs. What people don't know in the industry, and this is where I realized it, is the annuity sales guy. When I was in the mainstream financial services industry, nobody visited our office more than the annuity sales guy. Nobody took us to lunch more times than the annuity sales guy. Nobody hosted more contests for us than the annuity sales guy, right? They had a guy dedicated to our office to make sure we thought of Lincoln Financial Group and their annuities first because they wanted our business. So that's another one that's undisclosed is you don't, like, I remember sitting there, I won a contest one time. We went and got sushi. First time I ever had sushi, right? And all of these financial advisors, like, they wanted to win the sushi contest. It was released the quarter prior. Hey, if you get a certain amount of sales volume, the Lincoln Financial Group guys are going to take you out for sushi. Okay. These guys, these are 40 and 50-year-old grown adults. They were willing to put their clients in that annuity so that they could win free sushi. Think about that. Okay. There's also trips. Some of these insurance companies, they offer just glamorous trips. You can win trips to Hawaii. You can win trips to the Mediterranean. You can win trips to the Caribbean. Right. I actually won a trip one time and I didn't go. It was to, Lexi was pissed too. It was somewhere in Mexico, Playa del Carmen. Do you know where that is, Nino? Playa del Carmen. It's like a luxury resort in Mexico. I won the trip because of my production. And then when I started having all these realizations, I was like, I can't in good ethics go on that trip. Okay. Because I know where it came from. So not only are they guaranteeing against loss and they're doing all this stuff, they're also paying for trips for thousands of agents. Okay. Now, I'm not socialist. I'm not telling you don't make profit, but I'm telling you the client doesn't know about any of this. The client thinks their money is being managed. The client thinks they were being given the best possible solution. Okay. They don't know about that's a conflict of interest. In my opinion, if somebody says, hey, if you sell this and I pay you more and I give you trips and bonuses and incentives and I wine and dine you and take you out to lunch, I'm no different than a politician with a freaking lobbyist in their pocket. No different. Guys, do you know how many people take me to lunch now? None of my vendors take me to lunch. None of them give me trips. None of them come to my office. I don't want them to. That's not what they're for. They're for serving you. So if they come to my office, it's like, what the hell are you doing in my office? right? If they're like, oh, I want to take you to lunch. I already ate. Uber Eats. I didn't have to sit there and talk to you for 45 minutes about why I should sell more of your products. Right. Those are, and those are meetings where I feel like the client should be present. If I'm a financial advisor or an insurance agent, I'm going to go to lunch where a vendor's going to treat me and they're going to offer me incentives to sell their product. The client should be able to be a fly on the wall on the conversation to know that is a factor in what's being recommended. Okay. So I get passionate about this. Again, annuities aren't bad. They're amoral, they're inanimate, but there are uneducated and unethical insurance agents and financial advisors that sell them in the wrong scenario. What would the purpose of an annuity be? The purpose of an annuity would be to guarantee against loss, regardless of rate of return, to provide some kind of return and to generate income for life or for a fixed period. That would be the purpose of an annuity, right? And the ideal audience for that would be, again, someone with a smaller account value that has very little investing experience, right? It's in an IRA or a 401k already. They already have the tax ramifications. And that's the only thing that makes sense for them at that moment. Okay. Or someone that's older. They've got retirement funds. They shouldn't be in the market. They're conservative, whatever it might be, right? That's the audience. They're maybe going to run out of income. Let's generate guaranteed income for life. We've helped them now, right? But most people that buy and sell them, they're not that. They're 30, 40 years old. They've got plenty of time. They can make it happen. And they're being sold it because of commissions, licensing, uneducation, unethical behavior, all these different things. Okay. So that's all I've got for you guys tonight. I'm going to wrap up here and answer some questions. If you are in Zoom on the comments, drop any comments, questions you have. We will go live with them. If you're on Facebook, do the same. And we will just read through them here really quick. Good to see everybody. Justin, good to see you. Bob, good to see you. Brad, good to see you. Okay, I don't see any questions on Facebook. I don't think I see any on Zoom either. Let me just check really quick and see if there are any. Yeah, I don't see any questions on Zoom. Good. So to wrap things up here, guys, I hope that this was interesting for you. If you're like me, like this is just enjoyable to learn about. I like gaining financial education. Okay, I do see a question here on Zoom. We have a question from Clayton Lewis. Let me bring Clayton on live here. All right, let's see if Clayton can mic up and we'll chat and find out what his question is. All right, I don't think Clayton has a microphone. So let me just read his question here and I'll answer it. Okay, Clayton says, thanks for the lesson. Can you talk about inflation and why you estimated at double the CPI, Consumer Price Index? I'm not going to have time to run that entire thing tonight. That's a lesson in and of itself. CPI means Consumer Price Index. We actually did a course on inflation maybe about 2 months ago. If you go to my YouTube channel, you can find it. Another good resource is shadowstats.com. Basically the mathematical formula that we use to equate CPI, they've changed it several times, right? So back in like the 70s and 80s, they had one formula that was pretty accurate. Like it was a real feel of what inflation was like. They changed it. Okay. And funny thing is the 70s and 80s, that's when inflation blew up, right? So part of fixing it was, well, if we change the stat, it won't look as bad, right? It's like, you know, the thing about with kids that can't study, if we lower the expectation of what their grades should be, then they won't fail as much, right? So they changed the CPI indicator and the measurement of it to where today it's not realistic anymore. And so if you look back at that old CPI indicator, it usually does run about double what we see on CPI now. So that's another indicator. Again, I have a course on that maybe from 2 months ago if you go on my YouTube channel, and then shadowstats.com is another good place to look at that. So I hope that answers it. And again, that's a full thing we could just talk about in and of itself. Good. I think that's all we have for tonight, guys. So we're going to wrap up here. If you are watching and you are not yet a client of Wealth Dynamics, you haven't read any of my stuff, this is your first time, grab a copy of my book. If you go to jerryfetta.com/B2F, you can get Blueprint to Financial Freedom. And again, this book gives you the ability to learn most of what I've learned. I took everything in my 10 years of industry experience, which really is probably like 30 years condensed into 10, and put that into the book on, okay, here's what I would do. And here's what I did do. And here's what I learned from the top 1%. It's not mutual funds, annuities, stocks, bonds, all the retail consumer mainstream stuff. This is actually what real wealthy people do to build their finances and build wealth. So you can get that again, jerryfetta.com/B2F. That's a great read. If you'd like to connect with our team, you can schedule a call with Nano. You can go to our website. We've got tons of free content. So that's a great place to check all that out. Other than that, have a good weekend. If you have any questions, reach out to us. We will be back again. Next week is Christmas, right? Okay. I don't know if we'll do one on Christmas Eve. I'll have to run that by Lexi. We might do it instead on like that Saturday. So next week, let's plan on maybe doing this on Saturday instead of Friday. Actually, is Saturday actual Christmas? Okay, so then maybe we'll do it on like Monday or Thursday. I'll send out emails and posts. You guys will know when it's going to happen, but it probably won't be on Christmas and Christmas Eve. Other than that, thank you guys for watching, and make sure you like and share this. I'll talk to you next time.